What's going on, YouTube? Back with another episode. Y'all, I know it's been a very long time since I have been putting out YouTube content. Unfortunately, I was on a extended holiday. I was on my Euro summer trip for 3 months. So now I'm wrapping it up so I have the time to do these macro outlook videos every Sunday. Before I get started, make sure you guys like this video, comment, subscribe to the channel, turn on your notifications. And yeah, if you have any questions about this video, use the comment section to ask your questions, or you can join my trading community where you can interact with other traders, and I'll add that into the caption on this video so how you can join. So let's pretty much get started. Before we hop into the technicals, I want to take a look at the data that came out last week so we can kind of get a recap of what happened. So if you are in my trading mentorship and you completed my trading mentorship, you should have access to the Minty dashboard. And if you want access to the Minty dashboard, join my trading community. You get access to this. I'm not going to dive into what is all on this Minty dashboard, but I'll probably do another video breaking down everything you can do on here. So one of the things you can do on here is you can see the economic calendar, and you also can see market news. I'm going to start with the market news because here our market news give us a daily brief, pretty much giving us an unbiased summary of what took place from the last trading day. So this was updated from Friday. Let's just take a quick read. So the recent macro picture indicates a potential shift in global economic momentum with signs of both strength and weaknesses. While the S&P sales growth is at a nearly 5-year high, European stocks are drawing investors due to strengthening earnings and growth. The U.S. labor market showed unexpected contraction in July. Meanwhile, China exports exhibits resilience despite new tariffs, contrasting with cooling data. So pretty much the currency bias is the U.S. weakened on job report. Canadian dollar strengthened on job report also. And the yen weakened by seventh consecutive months on declining household spending. And then we had Bank of Japan rate path is clouded by falling Japanese household spending. And this pretty much was the data that came out. So that's pretty much where we're standing. Going into this week, markets started to reprice that labor data to favor not really a cut, but not a hike. So that's kind of like how we ended Friday. Nothing crazy, nothing too over the top. What I want you guys to understand though, if we look at the economic data that came out for the U.S. labor market, now a lot of people confuse how this may play out, right? So if we look at NFP Friday, we had hourly earnings that came in at 3.2, which is kind of concerning, not too much. Then we had non-farm payrolls that missed, but unemployment rate beat. And when you're looking at data, you don't want to let one data point tell you the story. So if you're not familiar, NFP is essentially job creation. Are there new jobs being created in the economy, right? With AI coming in, with inflation picking up, businesses are pretty much tight to hire, right? And that's also the story that the unemployment rate tells us. The unemployment rate tells us pretty much the health of the labor market. With unemployment falling, that shows that less people are looking for work and more people are working. And that can lead into some inflationary pressures in the future, especially with this coming out from July. We have CPI that comes out this week. Unemployment rate can fuel over into pushing CPI higher. That's pretty much all we really got last week. Initial job claims came in a little bit shorter than forecast. Still a bit high, but not too much. ADP, that's private sector. Also, I'm not even looking for growth in the labor market, to be honest. I'm just looking for consistency, if that makes sense. So, going into this week for the dollar, we have the biggest data is Wednesday. We have inflation. They are expecting inflation to year over year to trickle down to 3.4. They're expecting core inflation to pick up month over month, and year over year they're expecting it to pick up, and then inflation rate month over month they're also expecting a big jump. Now remember, in July is when we saw the energy spike, right? The reason why the inflation came in low in July because that data came from June. In June, we didn't have that Middle Eastern energy spike, right? That came in July. So remember, data lags a month. So August will print the data from July. So with that being said, the talk about the town is that inflation could go up. If inflation goes up, the Feds probably keep their stance on holding interest rates, if not pricing in a rate hike. Now, on our market news feed, we also have some articles that came out. So the Federal Reserve, we have Fed speaking this week, but pretty much here we go. Will U.S. inflation be cool enough to trim bets on September rate cuts? What I love about this is that we pull all of these. We actually pull these data. These news articles that give you a macro picture instead of just going to different sites trying to see. We actually have our back end pulling news data that actually matters to macro analysis. So from the Federal Reserve, we got this article, came from Google News, Trading Key, and you can click on them and go to them and read them to build your analysis or just see. I'm not going to dive too much in it, but on Wednesday, the Bureau of Labor Statistics will release July CPI, which is the most important macro data event next week. In terms, CPI is expected to rise 3.4, which is still below previous, but core is expected to increase to 2.5. So if CPI here we go. So if CPI is higher than expected, especially if core services prices accelerate, the market may further increase probability of September rate hike. Now that labor market did make the market say, okay, no rate hike, but that always can come back. We will see. And if that happens, that is definitely going to have treasury yields pushing higher, and you should expect the dollar to gain strength, and tech stocks and gold could probably face some pressures due to higher treasury yields. And inversely, if the opposite happened, then Feds may cool. Growth stocks and gold obviously benefit. So don't want to really jump ahead into what the data it will be, but if we look at the month of July and look at what happened, you can kind of get an idea of where the CPI data may go. Now, I will tell you this. Donald Trump administration has been pushing out data that I don't think align with the markets. You can have the administration come back in. In a sense, it's kind of like a manipulation of data, but we'll see. Now, that's pretty much what we have going into our macro outlook, because I'm only focusing on U.S. markets and Japanese markets. So I'm really just going to touch on those economies. So let me just clear these. Let's go to USD. Let's see what we have. Japan. This week we have not much. We have growth rate on Friday, and we have Bank of Japan summary of opinions. Now, I'm going to talk more about my forecast on USD JPY. But for now, let's go ahead and just hop into the technicals and break them down. So starting with DXY, if you haven't taken a chance to read and download and read my ebook, I highly recommend you do that if you're going to watch these macro videos because I follow the exact same framework here from like an intraday perspective. So you'll be able to see how I follow my framework. So starting with DXY, we ended the week trading low from NFP. Hasn't done anything too shocking, but if you look over here, what I like to do is I like to look at the price action before we had a big move. So this is essentially the area that I will look at, and then I want to see how price retrace or pull back from the trend. So right now DXY has been, if I zoom out a bit, DXY has been trending to the upside really since that bottom of 95. But if we zoom in here, we're just gonna take a look at the price action from the last week, last 2 weeks really, and we can see that price range. And I'll delete this to kind of clear this up. Oops, let me go back one. All right, so this is that range that I was talking about. This is the big move that broke out. So when you're using the framework, you want to focus on where price was most stable, right? So this is where price was most stable. We can identify our swing low and our swing high, which is around the lower Bollinger and the top Bollinger. I'll make those yellow so you can see them a little bit more. Okay, let's pull this up some. Okay, sweet. So, and this is just to also back test. So we'll back test to that range before that move happened so you can see how that move played out. No crazy expectations. So obviously we can tell when the dollar was trading in this range, there was really no opportunities to buy, not really even to sell, because you're trading against the trend. So you just got to sit on your hands and wait for the deep retracement. So here from the framework, we're going to measure, because we're in a bull trend, we're going to measure from the low to the high, which is around the lower Bollinger and the top Bollinger. And then you want to pull your 50% down to that lower Bollinger, which is your support. So the retracements fall deep. So these are like, this is like the exhaust levels of the retracement. So we want to get the dollar as low as possible down to this zone before we start looking to buy again. So we're gonna make that blue. That's our buy zone. So let's text buy. Now remember, I'm back testing, so we're gonna move forward. So this was back on July 29th. This was about a week and a half ago. That's where price was at. So nothing you really could do but sit on your hands. If the market continued to rally, then you are printing. But if it pulls back, it's creating opportunities. So I'll just let this play out to see how the market played with the fundamentals. And boom, got us a nice, hit our nice buy zone, came back into that buy zone, and now we are in the buy zone. So with that being said, that's a clear indication of how the framework works. Now, a lot of people look at the framework and they say, oh, I just go straight to the Bollinger when the page loads. You want to go to the Bollingers when price is just stable, like in this range. Once it breaks below that Bollinger, that is exhaustion, right? So now we can start looking. Let's just go ahead and delete these since we got our fib set up. So now if we look at this from a technical perspective, especially on the 4-hour, the dollar looks like it's picking up probably a potential time to rally going into next week, especially if the fundamentals supported with that strong CPI coming from that economic data. From the macro situation in the month of July. Think about it. We had an energy shock. We also had the World Cup. So those can definitely add inflationary pressures. Also, if you're in my trading community, there was something that one of my members shared where, let me pull it up just so I can quote this correctly. It was actually some really good insight that came out from the White House senior advisor, where he said, I'm looking mostly at unemployment and it failed. And that's what you really should look at. He also said if you take out government workers, the World Cup, and jobs rose 100,000. So it wasn't any data that really truly supported a rate cut to save the labor market. Still a strong labor market, solid. So right now, this is not a signal, but I'm just letting you know this is a great area if you are looking to long DXY or long the dollar and other currency pairs. The dollar can definitely gain some strength from here. We are going to track this going into next week. If we break below this 99, then this intraday analysis is not as strong. Another thing I like to do is zoom out to the daily just to see where we're at. And this makes sense because it aligns right with the 100-day moving average. The blue line is the moving average, the 100-day moving average. That's in the ebook, the framework. And if you see, the last time we dropped below that 100-day, price decided to actually extend to a new high. So once you have a new high, you obviously need to wait for a pullback from that high. And that 100-day definitely looks like a nice support level on the daily to pretty much hold. And then also, if you look to the left, there was like this gap here that price is probably, this gap here, price is also bouncing off of too. So a lot of confluences that support a dollar strength from a technical perspective. There are some confluences from a fundamental perspective that supports a bullish move coming for the dollar also, but we'll see. That's DXY. Now, I'm not going into a ton of markets, just the markets that I kind of want you to, markets that can help guide you in other currency pairs also. But I'm going to tap into some currency markets. Now, if you are in my trading community, I will be dropping a daily live stream video where I go into many other currency pairs. So if you want that, just subscribe to my trading floor and you'll get those videos. Next, let's take a look at JXY. JXY has been doing pretty much all of nothing. So I have been a bear in the Japanese market for a while, especially short term. But if we take a look at this from the framework, remember what I said, if we let's back test this before the move. Oops, let's see. Start new. Okay, let's back test this. So this is where it was pretty much just no big moves, no breakouts below the lower Bollingers. So this is kind of like how we'll respect the Bollingers. So right now we are in a downtrend. So you want to measure from the high to the low. So if you were looking at selling USD JPY, if you looked at the index, it definitely let you know that there's about to be a rally or something because we're sitting at the lower Bollinger. I'm not buying it up because I'm trading against that short-term trend that I don't want to. So my goal is to sit on my hands and let this push up above that Bollinger to get me a nice short going back to follow the bear trend essentially. So if we let that play out to see where we're at, because we had that big move, boom, perfecto. So now, just like on DXY, this is essentially what have been our sell zone. And guys, remember, you can forecast this before it happens. So you're not guessing, right? I could have back tested this. Let's see. Let me leave that back test. Start anew. I could have back tested this and I could have just set this ahead of time because that's what the framework teaches you in the ebook. So the only thing you got to do is when price get up here, this is your time to sell. If you try to continue to keep buying USD JPY while this is sitting at the lower Bollinger, you're setting yourself up for a intense pullback because the index is telling you that it can rally from here. So if JXY rally, USD JPY falls. So the only time you can buy USD JPY is when it rallies to this sell zone, which it did. So you just sit on your hands, let it play out, boom, and you start getting your sales, essentially. So now, going into this week, household spending is down. The Bank of Japan is not in a rush to hike interest rates, really, especially coming from their last meeting. So we could see this literally consolidate back to this low this week. Back down to this low. There is a gap here that needs to close. So yeah, that's pretty much the setup for that. If you are trying to short currencies against the yen, I wouldn't suggest you do that because JXY is high now. It's at the resistance. So if you're going short USD JPY while this is at the resistance, you could experience a deep pullback on those shorts, and you will also probably pay swap fees because Japan still have low interest rates. So JXY still is bearish, definitely going into this week. Looking at the technicals that we have here on the 4-hour. Now let's take a look at a currency pair. We have Euro USD. If we see Euro USD here, same thing. We see price was ranging from this support to this resistance in these Bollingers. So I like to go from the high to the low because we are in a short-term downtrend with Euro USD because of the USD data. So again, if I wanted to backtest this to see where I can start getting my shorts at, I can backtest it back to here. And I'll know. Can I short it right here? You can, but your risk to reward is about a 1-to-1. The higher it goes, the more you can increase your risk, right? Now, if I let this, I'll set here. This is my sell zone. I let that play out. If we get that high, boom, we got that high. It was like okay, sweet. So now we are still in the sell zone. So going into this week, I also see a nice fall consolidation back down to that low. The fundamental support is, especially if we have a strong dollar this week. DXY is sitting at a low. Euro USD is sitting at a high. They are inversely correlated. It's probably not a breakout this week, but it's just probably a consolidation. But these are nice moves. If I short from here down to here, that's about 200 pips. Literally. Super simple, super easy, nothing too crazy. A framework that works. Now let's take a look at USD JPY. If we take a look at USD JPY, exact same thing. If we look at the support that's here, that's that support over here. It's kind of about a lower Bollinger. That's the range that it's trading in. And then we have the high Bollinger up here. Now, this is what I was telling a lot of people on X. If you were buying USD JPY before the intervention, you're already breaking the framework because we don't buy at the top of the Bollinger. We buy below the Bollinger at exhaust levels. Now, the intervention can make it fall a bit harder, and that is what we had. Now, the thing about the intervention is it could have it fall much harder than a traditional pullback. I don't really like to use stop losses, but I still manage my risk, and I'll talk about that in my ebook. But from here, we measure swing high to the swing low to the swing high. We pulled the wrong one down. Give me a second. All right, pull the 50 down here, boom. And this is what I mean. The intervention, it broke right below the 50. Below the lower fib level, the level 1. And this is usually where people who are buying this back up are setting their stop losses. And on that intervention, it makes sense. A nice little stop loss hunt below that level. That's why I don't key in my stops because that's quite a tight stop. Just think about it. If you was to long it here all the way back up to that high, I mean, you didn't get stopped out, but your trade went into about 70% of drawdown of that risk that you had. You still got to take that in consideration. Not too bad, but like I said, I don't manage my risk with hard stops. I look at them as zones. And anytime price go below that level, those are prices that you definitely want to buy. Those are like the sweetest opportunities because you have the least amount of drawdown. But I usually start buying under the 0.78, 0.6. Those are like the best opportunities that I usually see. So right now, the intervention did nothing but create opportunities for us to buy it back up. Yen will still be weak. Dollar is still going to have some strength. So we can expect to be back at 163 in a couple of days. Now, if you try to hop in this now, this is obviously what your risk looks like. You can wait till the open. If we have a gap down, I would definitely say take advantage of it. They're probably still trying to manipulate this yen market with intervention to help artificially strengthen the yen. We'll see when markets open later today. But that's pretty much it. Framework is giving us the buy opportunity still for USD JPY. Not too late to get in, but just watch your risk. Next, we have NASDAQ. NASDAQ is pretty much doing exactly what you should expect it to do. So right now, we are kind of, if we go from the weekly, we are in like a little bear momentum, right? We had that all-time high at like right around 31. Price has been trading low. We did get a bounce. If you see, there was some resistance that broke out right here that's acting as support. It kind of bounced, went back up. Now we're rejecting it. Now, intraday, we got to go on the 4-hour. So the rally for the last couple of days, NASDAQ made sense because it was down at the lower Bollinger. Clear as day. Now, we're still kind of ranging. We did break that support. So even if you use the framework if you wanted to buy it up, you could have because it's still like in a bull market, but still kind of like bear market. So really ranging market. But if you pull that 50 down, you clearly can see that the rally was coming. Now, since we are in a bear market, in my macro outlook, we got to do this the opposite way. So we go from the low to the high. From the high to the low. Pull the 50% up to hit. Really, because we didn't get a major breakout yet, we can work with the Bollingers here, to be honest. So from the high to the low, pull the 50% up to here. NASDAQ can still rally higher. It can rally as high as 31. If you enter now on a short, your stop has to be high above like 32-ish. So it'll give you like a 1-to-1 risk to reward. So I will either wait for it to pull up to like here to get into this sell zone. And that's when I start looking at my shorts, to be honest. So I'll start waiting here if we can go. But because I am in some shorts from those highs of like 30, I'm not in a big rush to enter into more shorts, to be honest. If my original short goes into drawdown, if it breaks above the all-time high, which is possible, then I'll definitely add more shorts. I know there's a thing out there that say you want to add positions to a winning trade. I like to add positions to like drawdown because my analysis are quite strong and I believe in my analysis. And if I'm selling and the market goes up, that's just creating liquidity for me to short, right? But if I start selling when price is falling, like if price falls, let's just say if I short it here and then I try to short here, why will I short when price is falling? Because that is now time for a correction. So that short has a higher chance of having drawdown, especially being at the lower Bollinger. So the higher the better to sell, the lower the better is to buy. So NASDAQ, we can see a rally, no big surprises, but I won't be surprised if we consolidate back down to that 27K level, especially if CPI comes in strong or if earnings start to trickle down. Next, we have Japanese stocks. Pretty much same thing. Well, not really the same thing here. Let me zoom out. I want to go to the daily just to get a clear picture. Exactly. Kind of like DXY. So if you see on the daily, the 100-day is holding support. I just want to key that so I can see where that is on a 4-hour when I go into the 4-hour. Okay, sweet. So here, price started to break out the lower Bollinger right here. We had 2 breaks, but the support really looks like it was around here. So if I wanted to back test this to here to forecast when that when I wanted to forecast my buy entries. So if I go back to here, I clearly can see we have a support, we have resistance, and keep in mind, guys, this is that resistance over there, a little bit higher than a Bollinger on the price action. Keep in mind there was an intervention in this market, so there was obviously a big move. So from here, we can see that our opportunities are below the 78.6, which is that yellow line from the 100-day on the daily, which makes perfect sense. So this is where I will start buying JP in 225, the Japanese nickel buy zone. So with the framework, if I let that play out, we had that intervention, price was going up. Remember, 78 point booyah, that's where we want to go. Came back down, boom. And I'm currently in this position, bought right here. Shout out to our TTFX mentor, Frank Ski, for giving us this call. So now I'm just waiting for this to rally back to that high, which was over here, which is about 73. So not really much you can do in this market if you want a nice asymmetrical risk to reward. Is pushing back above the 50. It's about to look like we're going to break above that 50 and again retest that all-time high possible. So Japanese stock markets, also with the Bank of Japan not rushing to hike rates, corporate earnings are still solid in Japan. We may see this continue to move to the upside. Next, we have Bitcoin. Bitcoin is just consolidating, not doing much. Perfect setup to see. We're literally just pretty much just ranging from here to here, right around the top Bollinger, lower Bollinger. So from this resistance, we are trending down. So high to low, bring the 50 up to the resistance. How high can Bitcoin go? It's really just ranging 60 above 67, really back up to 71. You know how Bitcoin gets; it's very volatile. Or we can just continue to fall from here. I've been selling Bitcoin since 113, 120. I'm really not interested in adding any shorts unless we get that high back up to like 71K, because that is a support. If you see, that's a support that got broken that never retested. So if we get a ceasefire deal, we may get a spike up to 72K to that support that we retest. But that would be our beautiful sell zone. Do I want to buy that up? Not at all. The chances of okay, there we go. The chances of it falling in my macro outlook is much higher than it rallying. So I'll just sit on my hands. If it pushes up to above 70K, I'll sell it. If not, I'll just let my shorts that I have in play continue to print. That's Bitcoin. Nothing too crazy. Very simple, easy. Follow the framework. And then to everybody's best friend, gold. Gold really hasn't done much. Gold, if we zoom out to the daily, gold is just consolidating. And it's still trading below the 100-day. So this is the resistance that it's been ranging really in between. And if you see, I zoom out just a little bit, it's still kind of trending down, right? Now, no surprises that it rallied because it was at the lower Bollinger at 40. So we got that breakout from an intraday, but still in that range. And then if we draw our fibs from here before the breakout, the low to the high, we are literally in our sell zone. So again, no surprises on gold. If you are buying that up, trying to expect a push higher. I don't know what fundamental data you have. Treasury yields are staying up, even with the geopolitical conflict that's happening. Treasury yields are still high. They're not believing the bond market is not believing whatever they're trying to convince us to see. So the bond market is pretty much telling the story. Bonds are falling, yields are up, even with the geopolitical conflict. So gold isn't really catching that safe haven bid. It's really just catching that relief rally from the pressure. It's catching a relief rally from the pressure of the negative NFP. That's pretty much it. And it's just consolidating. It's not really creating new highs or new lows when you zoom out. So right now, gold is sitting at a nice high. And if you was to even back test it, you should never sell until you really got above 4,300. So that's pretty much that. So that's all I got for you guys. Quick macro outlook for the week. Like I said, if you have any questions or any insight, leave it in the comment section. Don't forget to like this video, comment, subscribe, send it to your friends. The link to join my trading community will be in the caption. And like I said, if you want to dive more into other currency pairs, other markets, join my trading community where I'll be uploading my daily live streams to my Discord channel for that. And I'll see you guys on Sunday. And if not, if you don't follow me on X, follow me on Twitter. I'm very active on there with my daily market sentiment commentary. So that's all I got for you guys today. Let me know what you guys think in the comments.